Good morning, everyone. This is Amit Pabari, founder and managing director of CR Forex. At this point of time, the world is facing two bigger risks. One is rising yield across G7 countries. Second is rising geopolitical risk. If you see the chart, from the chart you will be able to understand that all major countries long-term yields are trading at a multi-year high. For example, US 30-year yield is trading highest since 2007 and Euro trading highest since 2011. The main reason is rising debt. In 2007, debt to GDP ratio of US was close to 65%, today which is trading near 124%. For Japan, which was at 150, currently it is at 237% of its GDP. So basically, why this is a problem? The problem lies as we are expecting inflation to rise because of supply side constraint. In a current environment where the debt to GDP ratio of most of the G7 countries are above 100%, it will be difficult for them to increase the interest rate. As a result, we might enter into a zone which is known as stagflation. The second problem is rising geopolitical risk. By looking at the crude price, people might assume that geopolitical risk has come down. But if you see the chart, number of ships passing through Strait of Hormuz in the month last year was 120 and today it is just at 14. This is indicating that geopolitical risk is there and crude oil prices may move higher. The second chart is telling us a story that US strategic reserves of oil is at lowest since last 40 years, which is also indicating that there are only little possibility that oil can move lower from the current levels. Now, based on this two problems, let us decode what impact it is going to have on crude oil prices, volatility index, US equity market, emerging market, and finally gold. For oil prices, we are pretty sure that 80 is going to act as a new support level for oil, and there are 90 to 95% chances that oil is likely to move towards 100 to 105 dollar per barrel in coming days. The second indicator is volatility index. The volatility index chart is suggesting that volatility is at the lowest level in the equity market. Historically, whenever we have seen those level and taking support from those level, generally VIX moves higher. Whenever VIX move higher, it indicates that riskier asset might underperform. Now, as far as riskier assets are concerned, we are very bearish on US equity market. If you see the chart, from the chart it is showing that even though Nasdaq is making a new high, major hedge fund are reducing its position on a everyday basis. In last couple of days, hedge fund have reduced 21.6 billion in 1 week's time on a longer side in Nasdaq. So for Nasdaq, we are expecting that 30 to 31,000 is going to act as a strong resistance, and we are expecting it can fall towards 24,000 to 24,500 in coming days. For S&P 500, we are expecting that 8,000 to 8,100 is going to act as a strong resistance, and probably it can move lower towards 6,800 to 6,500 levels. As far as emerging market currencies are concerned, as the interest rate differential between US and EM currencies are getting reduced, it can have negative impact on all those emerging market currencies which are heavily dependent on flows, plus they are oil importers. India can be one of those country which can be negatively impacted by this. Now my favorite asset class, which is gold. On 29 June video, we suggested that gold is likely to move towards 4600 to 4800 kind of levels. We are maintaining the same target, that we are expecting it to move towards 4800. If that level is broken, then probably 5100 will be the next target for gold. Now let us discuss the outlook on rupee. There are few positive factors which has helped rupee to recover. For example, dollar index is trading softer. Plus, we have seen from the month of June, FIIs were net positive on Indian equity market. They have invested close to $6.6 billion. At the same time, we were able to get good amount of FCNRB deposits. However, saying that there are certain factors which can have negative impact on the rupee. For example, rising trade deficit. In the month of July, our trade deficit was trading at 6 months higher. We are expecting that trade deficit may continue to move higher, as we are expecting oil and gold prices to move higher. Apart from that, rising G7 countries yield, geopolitical tension, and expectation that the crude oil price is likely to move towards 100 kind of a level, RBI short position, and lower forward premiums. These are all suggesting that there will be pressure on the rupee, and 95 to 95.20 is going to act as a very strong support for the pair, and we are moving higher towards 96.20 to 96 and a half kind of levels. At this point of time, we will strongly advise importers to ensure that every dip is taken as an opportunity to cover their imports, and for exporters will suggest them to wait for higher level of 96 to 96 and a half kind of levels. With this, I will end my today's presentation. Jai Hind. Namaskar. फिर मिलेंगे next week. Thank you.